Welcome everybody to the GHP Investment Advisors Annual Economic Forum. Just to get things started, we're going to start with a short video. Hopefully you're already familiar with much of what this video says, but it's going to set us up for a little bit of the conversation in a minute. Roll the tape, please.
Managing your money means more than just finding an advisor who can make a financial plan for you and trade stocks. It means taking on a number of difficult tasks and solving a wide range of complex problems. Whether it's something as basic as filling out paperwork or as involved as planning your estate, it's easy to get lost. That's why GHPIA developed a suite of services we call Financial Concierge. What is Financial Concierge and why do you need it? Think of a concierge as a white glove professional who provides a high level of personalized service, takes on complicated tasks, and guides you through confusing situations. If you have a financial task that is making you anxious, we have a whole team of concierges who can help. Let's let them explain how it works.
One thing that's an issue for every client is tax planning. It's more than just filing your 1040 every April. How do you set up quarterly estimated tax payments? If you're a self-employed entrepreneur, how do you set up a retirement plan? Should you convert your IRA into a Roth? Everyone's situation is different, and we work with your trusted tax professionals to craft a custom solution for you.
Another thing that affects everyone is Social Security. When should you elect benefits? How should you time spousal benefits? We will walk you through the Social Security puzzle, even if it means going with you to the Social Security office. Or we can arrange a conference call so you don't have to wait on hold. We're all about doing the legwork so you don't have to.
Charitable giving is a concern for many clients. How do you align your investments with your philanthropic priorities? How do you make your giving tax efficient? Should you give appreciated stocks? Should you use a donor-advised fund? Could your IRA distributions be part of your giving strategy? Should you consider creating a private foundation? We can help you plan your giving so that the causes you support get the most value out of your charitable dollars.
Estate planning involves a variety of issues. Do you need to set up a trust or a family limited partnership? Or do you just need a simple will? Do you need referrals to trusted outside professionals like estate attorneys? Do you even know where all your important papers are stored? It's a jungle, but we can help you navigate it.
Our financial concierge team can walk you through these financial mazes and many others, take burdensome tasks off your plate, and bring you greater financial peace of mind. If your advisory firm doesn't offer financial concierge services, come talk to us.
Thank you for joining us today. I'm Brian Friedman, the president of GHP Investment Advisors. I'm pleased that many of you do not know who I am in this room. When I started GHP Investment Advisors in the 1990s with my partners, Bob Hochstad, who's here today, Jerry Kaiser, who's here today, and Steve Levy of blessed memory, we had a goal in mind that we were going to combine a high level of skill, expertise, with tax, financial planning, and investment management in a one-stop shop. We created the whole idea of financial concierge in our own minds, in all honesty, to typify the kind of service that we wanted to deliver to our clients. And what I wanted to do before we get into the substance of today's conversation, which my colleagues to my right will dig into, I just wanted to take a few minutes to highlight who these people are. Not everybody sees them all the time. Some of you see some of them. Many of you don't see any of them. But I want you to know it's an incredibly important part of what we do to deliver the kinds of advice and service to you, our clients. The other thing that you also don't see, that I want to emphasize, I hope Bob Hochstad doesn't mind, but for most of the 25 years that he and I have been partners, I called him the great socialist. Now, that's not because he's a Bernie Sanders supporter. It's because he believed, like I did, that we should share the wealth. that we should share the wealth with our team and with people that are important to making your experience as clients what it is, and hopefully what it will continue to be and improve upon. However, unlike Karl Marx, our motto is from each according to their abilities, to each according to their impact and advice and service to all of you as our clients. That is how we have always operated, and that's how we will continue to operate. So I just want to take a minute and highlight for you the skills, the subject matter expertise, and the service capabilities that we have developed over the last 25 years by introducing you to some of the people that we consider to be financial concierge and epitomizing that type of service. So if this team over here wouldn't mind standing for a minute. Many of you know many of them, but I want to highlight Deirdre McGuire has not only been with us for more than a decade. Deirdre McGuire is a shareholder and owner and partner of GHP Investment Advisors. She works alongside Barbara Terrazas, who is a shareholder and owner of GHP Investment Advisors. She works alongside Angie Lee, who is also a CPA and tax expert, also an owner and shareholder of GHP Investment Advisors. We have Michelle Mills, who is not with us today. Jenny Wenner, many of you have interacted with her, also an owner and shareholder in GHP Investment Advisors. Who have I forgotten so far? Sean Tully, one of our newest members of our team, and Ernesto Montez has also been a rising star amongst client relations and this financial concierge concept. Today, we're going to present a great deal of economic and investment information to you. I want you to know that you may not interact on a daily basis with our research trading and what we call research trading and portfolio analytics. It's headed by Brad Engel, all the way in the back, our director of research trading and portfolio analytics. We took him from Marsico Funds more than a decade ago. He is an owner and shareholder of GHP Investment Advisors. Christian Luton, our lead analyst, we stole him 5 years ago, from Janus, and he then got poached from us by one of these highfalutin investment research shops, and we poached him right back. Christian is an owner and shareholder in GHP Investment Advisors. Jason Kittner, also one of our lead analysts, spent 20 years in a senior management role at a major brokerage firm. Also an owner and shareholder of GHP Investment Advisors. The newest member of our team, Drew Sutphin, we welcome him. We have a very deep bench. Christian and Brad helped prepare much of the data and analysis and charts that you're going to see today. Brad, Jason, Christian could easily sit in these chairs to my right without anybody missing a beat. Our bench is deep, our subject matter expertise is deeper, and we're proud to highlight all of this to you today. It's taken 25 years to get to where we are, but it's all designed to create impact and a quality experience for you as the client. So of course, if you aren't experiencing that, please let us know, and many of you over the years have. Thank you, everybody. And before I pass the baton to the remainder of my team and introduce them, I really do mean it. Every once in a while, things go wrong, and we very much appreciate it when all of you let us know. That's how we learn, that's how we grow. They say behind every sign, there's a story. Behind everything we do, there's something that might have occurred that we tried to fix and improve upon. We will continue in the coming 25 years to build upon this foundation of subject matter expertise and service that we've laid over the previous 25 years. Thank you to our great socialist, Bob Hochstead. He's the reason that we have employee ownership throughout our company, and we will continue on that path. To my right are people that almost all of you know. Mike Sullivan is going to start today. Mike also, of course, shareholder and owner of GHP Investment Advisors, longtime partner of me and Bob and the rest of the team. I forgot to throw in a little bit of bragging. We have an alphabet soup. Mike is a certified financial planner. So is Reed. So is Carin. Sebrina, a CPA and a certified financial planner. Same with the team down there, CFP, CFA, PFS, ABC, Abracadabra. We've got it all. I'm going to start with Mike Sullivan because my role today, as you can probably already tell, is to introduce and brag about the group that we've assembled and let them show you their stuff. Once again, my name is Brian Friedman, and I approve the following messages. Sebrina Ivey, Reed McCoy, Carin Wagner, that is our advisory team along with myself, backed up by all of the people that I just mentioned a few seconds ago. I'm going to turn it over to Mike, and we can begin the more substantive part of our program.
Thanks, Brian. And thank you all for being here. It's really wonderful to have you back in person. I can assure you, after over 1,000 Zoom meetings in the last 2 years, all of my colleagues, we are not wearing sweatpants behind this table. We're dressed professionally. But I'm going to cut right to the chase. Obviously, we're in the midst of a stock market slump. And so I want to talk about some of the four-letter words that have been bandied about recently, those being inflation and recession. I'm going to speak about how did we get here with these high levels of inflation? What are the short-term implications for the market over the course of 2022? And what are some of the encouraging medium to long-term trends that we find in the market fundamentals and economic data? What I'm showing you here is the inflation reading, which, by the way, was just updated this morning. The monthly reading is still persistently high, above 8%. It's the highest level of inflation that we've all had to deal with since the early 1980s. Some of the people that Brian just introduced, it's the highest inflation in their lifetime. We are seeing pervasive inflation almost across the board, whether it be airfare, obviously gasoline prices, used and new car prices, all acute price increases in the last 12 months. We got here from three primary factors that all created this recipe of elevated inflation. One would be labor demand. Two would be the surging consumer demand over the last year, the second half of the pandemic, if you will. And then all throughout the pandemic, we've had supply chain snarls as the third major factor driving inflation. I want to get into one of, let's show, this is the 2-year U.S. Treasury bond, which currently sits at 2.6%. And you'll notice a rather steep slope. As of Thanksgiving, roughly 6 months ago, that 2-year Treasury bond was less than 0.5%. We all know that in the last couple of months, the Fed has begun to aggressively or expeditiously, as they say, tighten monetary policy, which means they're raising interest rates and they are reducing the size of their $9 trillion balance sheet. That aggressive monetary tightening is in response to these elevated levels of inflation. As of now, the Fed has raised interest rates from virtually zero a couple of months ago to now 0.75%, and the guidance is that they will bring the Fed funds rate to roughly 2.5% by the end of this year. I'd like to distinguish that the bond markets are already there. They are out in front as a leading indicator, just like the stock market. The bond markets are a leading indicator of where interest rate policy is set to go. I believe that the steepness of this slope, that rapid interest rate increase, is unlikely to be repeated in the next 6 months, but interest rates will continue to rise because inflation levels are stubborn. But to reinforce that the indigestion that the stock and bond markets have been feeling over these last several months, the slumping portfolios, has everything to do with the rather overnight shift up in bond rates and the continued guidance in higher interest rates from the Fed. Let's get into one of the drivers of those three factors for inflation that I summarized. This is labor demand. And this is a good news, bad news story here. On the left, you're looking at the total job openings in the U.S. economy. We just hit record high job openings, 11 million. Pre-pandemic, in 2019, which was a incredibly strong job market, we had only 7 million job openings. So we've added 4 million job openings recently, and that is good news for applicants, incredibly strong job market. On the right, you're looking at wage increases. The growth of wages has been across all spectrum, the entire spectrum of income, lowest wage earners being the fastest increases in wages over the past few months. These are good trends. On the bad news side of this, because of this heavy labor demand and shortage of labor, there is increasing pressure on inflation. And if we are unable to quickly fill this gap of 4 million job openings up from 7 million, that kind of labor shortage gap will add persistent inflationary pressures on wages. We have seen good trends, good news trends in the last year or so. From the depths of the pandemic through today, the increased participation in the labor force has softened some of this labor shortage. But these trends are gradual, and that's one of the main themes that I want to convey. Some of the persistent inflation pressures are abating, but only gradually. One of those being the return to the labor force of some that left during the pandemic. We have seen improving trends, but only gradual. This is a reading on the core consumer price index over the last 12 months. And this reinforces that theme, that inflation trends are gradually improving. Core inflation excludes food and energy prices because those are more volatile. And you might say, well, why then are we looking at core prices? We all drive and we all eat. So what's the relevance? When the Fed sets monetary policy, they're looking at core inflation readings specifically. And those trends are actually moderating somewhat, but it's a muddled picture. And you can see just with the direction of the arrow, the rather elevated levels of inflation that we're confronting, that 8% or higher that I started with, we've only seen gradual reduction in that rate from a core standpoint over the last several months. We have seen things like in the United States, supply chains have been improving. Factory production here is now running at or above pre-pandemic levels, which is good news, and it eases some of the supply chain drivers of inflation. But we all have heard, I'm sure, that in China, they are still in lockdowns in places like Shanghai. So the supply chain is a muddled picture. We have seen some loosening of those issues, but it is only gradually improving, and we still have persistent supply chain snarls through today. Sebrina is going to speak in depth about the pricing dynamics in the energy market. If we look at just where energy prices have gone over the last couple of months, oil prices have fallen since the invasion of Ukraine by Russia. But she's going to really hammer home and contrast the difference between the current pressure we're feeling in oil prices versus the hyperinflation era of the 1970s. So I'll leave that to her in a moment. I also want to get into the personal savings rate. This is something that our team of analysts, we spend a lot of time looking at, as it's an indicator of when we may have some level of reduction of this surging consumer demand, which is another big driver of inflation. Here we're looking at the average savings rate for Americans over the last 20 years, which is about, the average American saves about 7% of their disposable income per year. We as wealth management advisors, we would always advise that you save a multiple of that in order to create real wealth over time, but the average American about 7%. In 2020 and 2021, you'll notice we had this rather significant spike in the savings rate for two reasons. One, we had consumer demand that was severely curtailed by restrictions because of the pandemic, lockdowns and what have you related to the early phase of the pandemic. Two, we had massive levels of government stimulus. Just to put this in perspective, we, by way of fiscal stimulus, added $6 trillion to consumer spending levels in 2020 and 2021. In the entire world, there's only 2 countries that have more economic output than $6 trillion. That's the United States and China, just to put that number in perspective. It represents $6 trillion of consumer stimulus, roughly 30% of our annual economic output, or GDP. So that was a rather large level of stimulus that's going to take time to work its way through the system. Consumer spending, therefore, we expect to remain elevated for quite some time, and we're watching these personal savings rates to serve as an indicator as to when spending levels may soften somewhat. And only just recently has the savings rate dipped below those historical averages of about 7%. When we look at this, we think of it sort of like human nature. If I doubled down on my savings last year, then I might as well double down on my spending this year. We think that we're probably looking at elevated levels of consumer demand, consumer spending, and reduced consumer savings rates for at least another 6 to 12 months or so. So back to how did we get here? This is looking at on the left-hand side, you'll see a chart showing the GDP growth rate in the United States over the last 40 years. We ended 2021 with the strongest year of economic growth since the early 1980s. The Fed is worried now about the economy overheating. They want to raise interest rates, reduce the size of the balance sheet, tighten monetary policy to prevent an overheating economy and get a handle on this persistently high inflation. By raising interest rates or tightening monetary policy, they are seeking to slow economic growth without tipping it into recession and without materially raising unemployment rates. That's a delicate balance, but what they're trying to do is pull off a so-called soft landing, raise interest rates without tipping the economy into recession. Over the last 80 years of Fed monetary tightening cycles, we have 11 periods to bring to bear. 8 out of 11 periods of rate increase or monetary tightening cycles, 8 out of 11 have resulted in recession. Only 3 times has the Fed raised interest rates over the last 80 years without precipitating some measure of recession in the US economy. In those 3 episodes, mid-1960s, mid-1980s, mid-1990s, all 3 of the so-called soft landings that were accomplished, we had lower inflation levels than we have today. So the threat of recession is real. This is why the stock portfolios are slumping year to date. Market sentiment has turned sour because the history is not on the side of the Fed pulling off a so-called soft landing. A couple of things that I would convey to that in closing. Number one, obviously in recent history, the last 2 recessions we've all endured were coupled with pretty steep stock market losses. 2020, we had a 35% stock market loss during the pandemic recession. 2008, we had a 55% stock market collapse during the financial crisis. It is in our earliest memories that recession equals stock market collapse. Historically, going out beyond 2008, there are a number of recessions in the United States that did not come with severe stock market losses. That's point number one. Not always do we get recession equaling stock market collapse. Secondly, we see a number of rather impressive financial and economic trends that we think would either allow the economy to avoid recession, a so-called soft landing, or if we should have recession, pull off potentially only a mild recession. Those would be factors like this on the right-hand side, corporate profits. Corporate profits today sit at over 70-year highs as a percentage of GDP. Profitability in the corporate sector is incredibly robust. This has led to improving stock market valuations. They are quite attractive at this point. Carin's going to hammer this point home in her presentation, but profitability and stock market valuations are attractive at this point. Corporations have also used this improved profitability and low interest rate environment to solidify their balance sheets. Banks are incredibly well capitalized and have very sturdy balance sheets. And then finally, household finances are remarkably strong at the moment. We're looking on the chart on the left, the blue line is total debt in the household sector. It's about 18 trillion. The purple or lavender line is total cash on hand in U.S. households. It now exceeds total debt in the household sector. This is a Deutsche Bank chart that was just released last week, and we think it really helps to bring home the point that household finances are incredibly strong. They are flush with cash, more cash than debt on hand in aggregate in the household sector. So in closing, when we look at Fed tightening cycles and we fear recession and we confront stock market slump, as the rate tightening is potentially flirting with such a recession, we want to reinforce that whether it be the strength of household finances, the improvement of bank balance sheets, the strength of corporate balance sheets, or attractively low stock market valuations, these are encouraging trends for the medium to long-term prospects in your portfolios. I want to turn it over now to Sebrina to talk about the pricing dynamics in the energy markets. And again, it's great to have you all in person here today. Thank you.
Let me figure out how microphones work first. Recently, most of the conversations, or many of the conversations we've been having with clients have been about one thing. Are we returning to the 1970s energy crisis? Closer? Apparently, I'm not loud enough. I'm also going to confess that I was not born until August of 1979, so I had to do a little bit of research to really understand what happened in the 70s. Although we've heard some stories, including just one this morning, of challenges that people really faced. I thought we'd just set the stage a little bit for anybody who is not alive in the 70s like me. Gasoline prices are high. Oil supplies feel tight, and the president is under enormous pressure to curb inflation. Large exporters are cutting oil supplies in response to military actions and support offered by America to our foreign allies. Please remember, I'm still talking about the 70s. In October 1973, the Arab state members of OPEC declared that they would cut oil production and limit exports in response to the United States' support of Israel. The president reacted by instituting a rationing program that led to shortages at gasoline stations. Americans lined up at the pump, and the debate about foreign oil began. Anxiety about the dependence on foreign oil merged with growing environmental concerns, and activists declared that energy conservation and new energy sources would solve all of the energy crisis. In 1979, forgot about my slides, sorry. In 1979, following the Iranian Revolution, a reduction in oil production resulted in a doubled oil price over 12 months. So going back to January of 1970, a barrel of oil was priced at $3.35. By March of 1980, $39.81, over 1,000 percentage point increase in 10 years. Jumping forward in time, in December of 2019, before COVID changed our world, the cost of a barrel of oil was $61.14. By the end of March 2022, we were over $100 a barrel, a 64% increase. Putting that back into the context of the 1970s, for the increases in oil to be commiserate with what we experienced in the 1970s, oil prices would need to be about $700 a barrel. We are not there. I'm not denying that we have had significant increases in the prices we are paying at the pump these days, but it's not the first time that we've seen these prices. Does anybody remember the last time a barrel of oil was priced over $100? Yell it out. Bob, you can't cheat. 2014. So we are not in unforeseen circumstances right now. The economy is reopening. People are back behind the wheels of their house, and following shutdowns for much of 2020 and 2021, demand is up from the pandemic lows. However, neither OPEC or the United States has returned to our pre-COVID production levels. Further inflating fears over oil supply, Russia attacked the Ukraine in early 2022, and energy giants such as Shell, BP, and Exxon pulled out of Russian energy deals. The United States announced a ban on Russian oil imports. We're talking about short-term issues with a lot of potential sources for answers. Actually, let me show this one. The United States is the largest consumer and producer of oil in the world today. We are not the country with the largest oil reserves. Our reserves are estimated to make up about 4% of the world reserves. Venezuela has the most oil in the world, but much of its oil is offshore and underground, and it is dense, which requires additional refining. Saudi Arabia's oil reserves, on the other hand, are close to the surface and on land, which makes the oil much more accessible and cost-effective to extract. Iran and Iraq are numbers 4 and 5 and have been heavily sanctioned historically, impacting their production. The United States first sanctioned Iran in November of 1979, following the Iran hostage crisis in which the American embassy was seized in Tehran. Sanctions were reopposed in 1987, 95, and 2006. Sanctions against Iraq began in 1990 following the invasion of Kuwait. Although their sanctions have been lifted, negotiations and corruption have prevented them from making as much as possible of their reserves. In April of 2022, the Deputy Prime Minister of Iraq stated it was unlikely they would be able to compensate for the Russian supply, but we do believe that they are working on improving their infrastructure and compensating for their restrictions. It's not clear yet what that will be. Politics, more than actual shortages, may continue to impact our oil prices as production returns to pre-pandemic levels. While the short-term issues aren't to be denied, in 12, 24, 36 months, I suspect we will start to see a decrease, and maybe we'll even get back down to pre-pandemic pricing. A longer-term issue, a longer-term issue and not as easily addressed remains in the reliance of natural gas from Russia, particularly for the European Union. While the problems in Europe will certainly impact individuals and business, the reliance on Russian gas is largely a European issue. In 2021, Russian imports to the EU accounted for about 45% of gas imports and 40% of its total gas consumption. Natural gas is the cleanest burning hydrocarbon, but it is a gas, which means that it can easily escape into the atmosphere. It is costly to transport and to store. Additionally, it's highly combustible. Energy pipelines, such as the Nord Stream pipeline from the Baltic Sea to Germany, have provided an effective means to transport natural gas and allowed the EU, particularly Germany, to build a reliance on the Russian source as they phased out their nuclear power plants. Leading up to the Russian-Ukraine invasion, EU gas storage was well below levels seen in recent years, resulting from a very cold 2020 to 2021 winter. The 21 to 22 winter was mild in comparison. For 2022, this chart illustrates a scenario in which Russia no longer exports gas to the EU, and there isn't a change in demand or an increase in non-Russian supply. Under this scenario, storage levels would be depleted by early summer. Even if Russian gas imports are reduced to 50% of 2021, European gas risks depletion by the end of the year. For now, the biggest question facing European leaders is how to sever their energy dependence on Russia. The European Commission has released plans to curb imports of Russian gas by the end of the year, but that study relies largely on increasing imports of natural gas from abroad. In February, Germany suspended its approval of a newly built gas pipeline from Russia, and it is now planning to import liquefied natural gas from countries such as Qatar and the United States. March 25th, Joe Biden pledged to send more liquefied natural gas to Europe, and Germany has already signed a deal to import the product from Qatar. Similarly, Japan has indicated it will also divert LNG to Europe. European countries have been requesting additional liquefied natural gas imports from Qatar since shortly before the war broke out, but those imports present their own problems. They have to be stored and regasification, which sounded like a fake word, but that's the actual word. And they all said I would laugh, so I needed to laugh during that. Regasification and injection into the existing infrastructure. Longer term, the problems we're facing with both natural gas and oil are neither new or impossible to solve, but we are being forced to focus on them now. 2022 was a lucky year for Europe to face this challenge. A warmer winter led to overall consumption being lower and potentially leading to a false sense of security, maybe even some level of bravado. Many see these issues as a catalyst for the movement to renewable energy. However, that shift seems to take longer than Europe has if we return to a colder season. Homes and companies need to be heated, driving up the costs and potentially requiring some access to Russian sources remain open. I have a quote that I thought was interesting from the Executive Vice President for the European Green Deal, Frans Timmermans. He said, "It is time we tackle our vulnerabilities and rapidly become more independent in our energy choices. Let's dash into renewable energy at lightning speed. Renewables are cheap, clean, and a potentially endless source of energy. And instead of funding the fossil fuel industry elsewhere, they create jobs here. Putin's war in Ukraine demonstrates the urgency of accelerating our clean energy transition." That is easier said than done. This chart reflects the increase in electricity consumption from renewable sources in the EU from 2005 to 2020. It's amazing progress, but this is just the electricity consumption, not all energy consumption. Belgium is reconsidering its planned exit from nuclear power. Italy, the Netherlands, and the United Kingdom are all accelerating their efforts to install wind power. The German government is proposing to increase its share of renewable energy sources in the power sector, again electricity, from around 40% today to 100% by 2035. That is a lot of cold winters in between now and then. A draft proposal by the European Commission estimates that a rapid scale-up of wind and solar power could replace a significant portion of Russian natural gas this year through a combination of rooftop solar panels and solar panels that feed into the power grid, as well as wind farms. But energy experts suggest the Commission's target is too ambitious because of the time required for these. Meanwhile, companies that install solar and wind equipment say they're still continuing to experience supply chain issues, which will further extend how long it takes to implement. Onshore wind farms can be built in about a year. Offshore projects are closer to 3 years. Rooftop solar panels can be installed in about a day, but panels that link into the electricity grid take 6 to 18 months. Biogas is a combination of methane and carbon dioxide that is released when organic matter is broken down. It can be used to make electricity or heat, or even as a fuel for cooking. It can also be purified to make biomethane, a substitute for natural gas that can be injected directly into the existing gas infrastructure. Currently, only about 3 billion cubic meters of biomethane is produced in the EU, but the industry is in the early stages of a ramp up that will accelerate over time. In the last 24 months, 300 biomethane plants started operations in Europe, with France, Italy, and Denmark being the leaders. The industry believes it can produce enough biomethane to cover 30 to 40% of EU gas consumption, very close to what the Russian oil supply is right now. They estimate they can accomplish that by 2050. It is a long road, and for right now it's hard, but there are some solutions. Europe may not be able to fully eliminate its reliance on Russian oil this year. They may have to focus their time, money, and energy building that infrastructure. Countries may have to reverse course on their movement away from nuclear power, and they may need to do it all to avoid a calamitous winter. But it's not hopeless. There are some answers. And on that very pleasant note, I'm going to turn it over to Reed to talk about housing.
Thank you. Very good.
All right. Well, I want to approach real estate today from two different angles. One, what I'll call kind of the homeowners lens, and then another from a purely investment standpoint and how we would look at, in this case, real estate investment trusts, which we are analyzing to see whether or not they're appropriate for our clients' portfolios. So to begin with the homeowners lens, we are getting a lot of questions right now from both buyers and sellers, wondering whether they should be buying because they're going to be priced out and things are continuing to heat up, or if they should be selling because there's a bubble and they need to get out before there's a crash. So I'll kind of call this the question of are we heating, cooling, or crashing? And so to find the answer to that, we want to look at what are the causes that got us to where we are, which is appreciation, certainly somewhat unprecedented, at least until we go back to the 70s, but of 15 to 20% annually since 2020. So what got us here is really no surprise. It's low interest rates, strong balance sheets, and the stimulus, which have all been fueling demand while supply has been struggling to keep up. So I'll address each one of those in some slides to follow, but before I do that, while we're on this chart, I think for what I'll call the what goes up must come down intuition, I think very clearly in this visually you can see when looking at residential real estate, it may be that what goes up stays level, what goes up does come down somewhat or continues to go up, but there is not any trend when looking back in recent history of a depreciation, a significant depreciation immediately following a high level of appreciation in residential real estate. So that trend has so far not been bucked. And lastly on this, closer to the mic, oh, sorry. And lastly on this chart, you can see just for the tail end there, trend is emerging and somewhat apparent on the residential real estate prices in the last 2 quarters, not depreciating, but just starting to decelerate from the high levels that we saw about 2 quarters ago. So we may already have hit that peak acceleration and be in a situation now where we are cooling. That period of cooling down does correlate quite well with the expected and actual increase in mortgage rates. So looking at the 30-year mortgage where it is today at about 5.25%, having increased from about 3.25% average in the past couple of quarters. Now, certainly that is a drastic change when you're talking at 2% on top of a 3.25% base. Certainly not lost on us that is significant. But in relation to recent history, 5.25% is not all that drastic. It is not unreasonable to have expected that, and still actually could be considered at lows. To put that also in context, when we're talking about the macroeconomy and the median household's ability to continue purchasing homes, a 5.25% increase from 3.25% on the U.S. median home price which is actually $375,000. I realize that's not Colorado, but the U.S. median home at $375,000 with a 20% down and a 30-year mortgage, you're talking about a $350 per month increase in the amount that you'd have to pay, which is significant. And so that can be significant for some, but it's not going to price everyone out of the market. And that's exactly what we're starting to see, both in the numbers of demand on home prices. We're seeing that in prices. We're also seeing it, I don't have a chart here, but just yesterday the data came out on the first quarter of mortgage originations for new purchases, which has declined 19% since the fourth quarter in 2021. So just as we would expect, there's a little bit of a downward pressure on demand coming from the increase in mortgage rates. Like we are not seeing from the supply side much reason to believe that 5.25% by itself is going to cause a demand shock. We're also not seeing evidence of a impending supply shock. And so if you look at housing starts here, there's a blip there in the 2020 where it's significantly declined very quickly, but we're already recovered in the new housing starts to pre-pandemic levels, and actually we're starting to approach the late 90s and early aughts levels. Now, there's a delay on housing starts, and it tends to be somewhere in the ballpark of 8 months between a housing start and a housing completion. That may also be extended from what we've just seen in recent past because of the supply chain issues both on construction materials and labor. The construction materials side of that is actually improving and trending in what we would say is the right direction. As we just saw in Mike's chart, the labor force is still has not fully recovered or showing the same level of recovery there. So all of that is to say, we are still at low inventory levels, and there's not much to suggest that there's going to be a flood of new supply anytime soon. So that supply shock, unlikely, very similar to unlikely demand shock in what we're seeing in the data. To support that even further, again, on more of the demand side, there is plenty of room that we can see in households' ability to continue to consume and purchase homes. So I think it can be sometimes surprising for people that we are at 40-year lows still on the debt service as a percentage of disposable income. So we're roughly around 4% now, and that's a pretty historical low compared to the 6+% that we have seen and in years past. And I think it's also important to note that this is with disposable income increasing, real disposable income, inflation-adjusted disposable income increasing over that period of time. So livelihoods have been improving, and their debt service to mortgages have been actually shrinking and are still at low levels. So plenty of capacity here still for demand, which would suggest that the cooling trend that we're seeing may continue. There's little evidence to support that there's going to continue to be the level of appreciation that we've just experienced in the recent past, and there's very little evidence to suggest that there's an impending crash at this point with the data that we have. So switching gears then quickly to our real estate investment trusts and looking at real estate from more of an investment lens. The reason, by the way, that we differentiate between the two, between real estate investment trusts being non-residential, is because truly they really aren't. If you look at the entire market value or cap of real estate investment trusts, about 83% are invested in commercial real estate. There's a small 5% or so in highly risky, high leverage mortgage REITs, and then the remainder is going to be in residential. That residential is also going to include nursing homes, college housing, that kind of thing. So it's not your typical single-family home type residential investments that we tend to all make as homeowners. So that being said, our analysis of any asset class and investment begins first looking at fit and some of the unique characteristics of that particular investment. For REITs, that includes tax advantages and disadvantages. So there is an advantage investing in REITs. They are not taxed at the corporate rate. However, all dividends are taxed at ordinary income rates. There is some risks inherent to real estate, which is illiquidity of the underlying investments when you're investing in a REIT. And for that matter, the risk profile is somewhat determined by the small market. And if we actually look at REITs on the whole that you can invest in, that's publicly listed REITs. Again, I'm not talking about private investments, but publicly traded ones that we could potentially add to all portfolios. That's a market cap of $1.5 trillion. To put that in context, that is about half of what Apple was not that long ago, before the most recent drop. I think it's more like 2.5 now, but gives you that context of half of one of the largest companies in the S&P. And also in context, it's $1.5 trillion on what is estimated more or less of about $17 trillion of the overall commercial real estate market. So it's a relatively small portion. It would never be a large portion of our clients' portfolios, but the characteristics I've described so far, none of those are in and of themselves would cause us to exclude them from all client portfolios. There may be some where that does fit and for whom it does fit. But the valuation, when we drill down to that next layer of analysis, that it does tip the scales enough for us to exclude them from client portfolios. And you can see here why, which is if you look at our benchmark, which is that line just kind of in the middle of the page there has been very little periods of time in recent years where the real estate or REITs yields are attractive to us and above our benchmark So that alone has caused us to really exclude them. But then it makes sense if you compare that with that yellow line, which is the 10-year Treasury. Currently, the yields are below our benchmarks and are only spread only above the 10-year Treasury by 1.5%. So the amount of risk that we are taking by investing in a REIT right now compared to what we get on the 10-year Treasury, we're just not being compensated for that risk. So we're staying away from them, and that's why we have for a while. And unless these kind of conditions change, we don't expect to in the near future. So to follow that analysis, we actually thought this would be a good time to show a short video going into another metric that we rely on to when we go deep into our analysis. So we're gonna, before I go on to Carin. Yep. I don't know actually.
There is always a trade-off between the degree of investment risk and long-term investor profits. Our investment strategy quantifies these risk factors so that our clients' portfolios may achieve desired growth while avoiding disasters. Think of a 3-lane highway. The slow lane investor risks not accumulating and maintaining enough retirement wealth. The fast lane investor may speed ahead, but risk catastrophe when conditions change. GHPIA seeks the middle lane to achieve the best risk-adjusted investment returns to grow and preserve your wealth. Our team of analysts has developed a highly quantitative investment risk scorecard. Among the many risk scoring metrics calculated by our scoring tool, this video will focus on our profit stability score, which evaluates a company's operating risk. Operating risk involves a firm's exposure to factors that may shrink its profits or lead to bankruptcy. High fixed costs, poor management decisions, and product obsolescence can increase operating risk and reduce profits. Our scoring tool elevates firms with dependable profits over long periods and helps us avoid firms with sporadic profitability or exciting yet unproven business models. Imagine a plain but steady company that makes health products, something people always need, even in lean times. Now imagine a company that sells a flashy luxury tech product. Both might average the same profit over a decade, but the less volatile company will have a higher profit stability score. To long-term investors like us, that stability makes the company a more attractive buy. To calculate a company's profit stability score, we divide its average annual operating profit margins over a given time period by the standard deviation of those annual profit margins. If the score is high compared to its industry competitors or relative to the entire stock market, then our investment team considers that stock a stronger, lower risk prospect. Of course, a profit stability score is only one of several risk scores we calculate as we continue down our investment risk funnel to pinpoint companies we ultimately buy. Our proactive, quantifiable risk scoring technique takes the emotion out of investing and helps us strike the proper balance between risk and reward when we buy stocks. No matter which portfolio selections best fit your personal financial needs and goals, the best long-term strategy helps you avoid both excessive caution and excessive risk. Our profit stability score helps us stay in that middle lane all along the journey.
Can you hear me?
Yeah.
While Karen's getting ready, that silky smooth voice is Mike Sullivan.
Wait, he just took my joke. I was gonna, Brian.
Getting ready.
All right. Well, as you can see from the video, it was focused on the profit stability score, one of the key metrics we use in evaluating when we purchase a stock. But there are other metrics that we use, like leverage. So we look at debt relative to assets. We also look at business models. So think back 15 years ago to Blockbuster. And finally, we look at price. As you can see from my not slide, there we go, my slide right there. Today I'm going to talk about price or equity valuations. Like the profit stability score, we've created a benchmark of what we're willing to pay for a company relative to its earnings. Think of it this way. If you're going to pay $1 for a future earning and you pay $15 for that share of stock, then what you're expecting is about a 6.7% growth rate. It's just simple math, 1 divided by 15. When you look at profit stability scores and they look extremely low, it may be an indication that that company is going to experience financial distress. So that's why we get back into looking at the fundamentals of the company, like leverage, business model, profit stability, et cetera. The GHP benchmark, whoa, wrong way. There we go. The GHP benchmarks that we've created are based on our required rate of return relative to risk. For example, we're willing to pay more for a growth company than a value company. Growth companies, as a reminder, reinvest their earnings to grow quickly over time. Value companies tend to be slower growing and pay higher dividends. And we're willing to pay more for a large cap company than a mid and small size company. So think of Apple 35 years ago. There's risk that it could go out of business, that it wasn't going to create the MacBook, et cetera. And now, like I think Reed mentions, it's a $2.7 trillion company. And I was going to make a joke that we're all addicted to our phones. Can't leave home without it, but then I left it in the office, so I can't even tell that joke. The chart that's in front of you right now is showing you by asset class, so large cap growth, large cap value, mid cap growth, mid cap value, small cap growth, small cap value. The GHPIA stocks, those are the stocks in gold, versus the asset class index, that's the bar in gray, relative to our benchmark, which is the black line. And what it's showing you is that right now we don't believe that we are in an overvalued market. You can see that between the difference between the gold line and the black line. There are certain stocks, especially within the large cap growth sector of the industry or sector of the market, that we do think is selling for a high price, and we're actively avoiding those stocks. And I'll give an example of what that looks like and what it's looked like in the past in just a little bit. One of the things that you'll notice is because we don't think that we're in an overvalued market, and because, like Mike was talking about, we're in a very low interest rate environment, what we've done is we've allocated a higher percentage of our portfolios to stocks because we need to keep up with inflation. That wasn't always the case, and I was just looking at Reed's slide a couple slides ago, and it was showing you where we were allocating money back in the 2000s. So if you look in the 2000s, you could buy a NASDAQ 100 company for over 50 times earnings. We think that that size and style of company should sell for about 27 times earnings. So back in 1999, 2000s, we had a much higher percentage of our portfolio allocated to the REITs that, like Reed was saying, we're not buying right now, and allocated to treasuries. Back then, we could get a 10-year treasury and earn over 6%. Compare that to today, and right now, if you look, we're not in the overvalued market and in a low interest rate environment, which highlights why we're allocating more of our portfolios to stocks. What I'm going to do in just a second is give you an example of specific companies and why valuations matter. But before I do that, our Chief Compliance Officer, Sebrina, is making me have you read this disclaimer, so I'll pause for a second. Read. Okay. Now what I'm going to show you is two different companies. They're all done reading? Okay, good. Okay, so two different companies. On the left-hand side of the chart, we have Zoom. So Zoom's a COVID darling, and as you can see, relative to its benchmark, has been selling for a very high price. The benchmark is the black line at the bottom of the chart. Compare that to Cisco. Cisco's benchmark is at the top, the 27 times earnings. And what you can see is that Cisco's been selling for a price that's much lower than its benchmark. Cisco, in case you don't know, owns WebEx. WebEx is the video platform that's used by a lot of major TV stations. It'll say on a broadcast, this has been brought to you by WebEx, or you can also see it, a lot of times, a lot of large corporations use WebEx. So what you can see is throughout the period in time where in June of 2020, Zoom was selling for over 400 times earnings. Throughout the same time, Cisco was selling for a very reasonable valuation. Fast forward and look what happened. So let's take Zoom as the example. Zoom put its gas on the pedal. It's our fast lane company. Put its gas on the pedal, and it accelerated and hit its peak in October of 2020. At its peak, its market cap was $160 billion, which was more than Cisco. Cisco earns about 11% of its revenue from WebEx, but it's really more known for its infrastructure platforms that deliver networking capabilities and also store data. And so we joked around the office that imagine being the CEO around the boardroom table saying, if I just spin off WebEx, I can double the size of my company due to market hype. Well, clearly that didn't happen. So if you look at what happened over time is that Cisco returned a solid middle-lane company. Actually, it's had great growth. It's returned 45.5% since April of 2020, so 2 years. Divide that by 2, that's almost 20% per year. And compare that to Zoom that peaked in October of 2020, fell 78% from its peak. That's a crash. And then ended up the year over the 2-year period at a total return of 4%. Negative, sorry. So that's a 60% difference spread between the performance of Zoom and Cisco. So clearly, Cisco's an example of a company in the middle lane. Zoom's an example of a company that drove in the fast lane and crashed. We know that you've heard many times that past performance doesn't guarantee future results. And if you read the disclaimer, it was in the disclaimer as well. But with careful study of the past, whether we're talking about inflation and interest rates, like Mike discussed, or energy, that's what Sebrina talked about, housing and real estate, like Reed talked about, or stock prices, the past does allow us to make educated guesses about what's going to happen in the future. And right now, what the information is telling us is that we're not in an overvalued market, and that while we're going to experience volatility, we're not concerned that as long as we have enough highway to continue to drive, we're going to be just fine keeping our stock allocation. So now what we're going to do is we're going to have questions and answers. So we have Ernesto and Sean with microphones. So if you have questions, just raise your hand. And then after question and answer, Brian's going to do a quick wrap up and give you some reminders about the parking structure.
Thank you. While they're circulating with the mics, a few people emailed. Thank you for those who do their homework in advance. I was never one of those. There was a few questions that came to us that I thought maybe we could address while you guys are thinking of what you might want to ask, and just raise your hand and somebody will bring a microphone to you. What I thought I might just address, somebody asked about the way they phrased it were the runaway government deficits and the relationship of those deficits to inflation. So what I thought I might do is just first recommend to all of you a speech. I had the whole staff listen to a speech that Milton, well, I should say I forwarded it to the entire staff to listen to a speech on YouTube that Milton Friedman, the Nobel laureate, delivered in the 1970s. It's incredibly relevant to the situation today. I do apologize for his use of sexist language, however, given the 40-year gap. But it's very clear that the chart that Mike Sullivan showed with the personal savings rate, where the United States government handed out 1/3 of total income in the form of support and stimulus, and simultaneously the Federal Reserve bought all of that debt issuance, was the trigger of the current inflation. You combine that with the supply restrictions that we experienced during the early days of the pandemic, and the inflation that we are experiencing was predicted by Milton Friedman in that speech in 1979, when he said that if you do that combination of events, you will get inflation. The question is, how long? So I don't know if anybody else wants to add. Mike brought that up in a very good way, that we don't think it will be very long. But when the Federal Reserve says transitory, what the world hears is a few months. What they should have heard was a few years. Does anybody have anything they want to add on the?
Right. I think the only thing that was transitory about the Fed's statement was the use of the term transitory. What I was laying out when I kept using the term gradual, we're now about a year into this higher level of inflation. It's not hyperinflation like the 1970s, but probably another year or maybe more of elevated inflation levels. The Fed's looking for 3% inflation. That's a healthy level of inflation. That's their goal. I would be surprised if we get there within May of 2023, for example.
And then I'll just add, as it relates to government debt, right now, our interest expense to service our debt as a percentage of GDP is well below 3%. So I think that as a government, we still have room to borrow until either interest rates rise so much that, actually that will probably be the cause, is that we'll have rising interest rates, and that'll make our interest expense to service that debt higher, and then we'll really have a borrowing problem. But we've got some runway until we get there.
Any questions out there? Don't be shy. We understand that the stock market is down substantially, and be nice, but let it fly.
Hey, Brian.
Yes.
Remember, we were talking back when the tariffs went in on China, and we were talking about just-in-time deliveries and then COVID and stuff. The one I haven't heard mentioned, though, today is this grain problem in Ukraine. I think it's going to be a significant world food problem and how that will affect things.
Maybe I'll comment and invite Sebrina, because I think it ties into the broader conversation that she just had about energy. We didn't dig deeply into, I think one of the things that Sebrina mentioned, and correct me if I'm wrong, Sebrina, is all of these problems will likely be solved. So if we compare to the 1970s, when, for example, in oil, and I will get to the grain in a second, the Arab countries were 80% of world supply at that time. Today, Russia is 10% of world supply. The United States has the capability to completely replace the exported grain that Ukraine produces. But like Sebrina said, they can't do it. We can't do it tomorrow. There will be an adjustment period of a year or two. So the question is, what happens when you're in a war situation? It's measured in weeks, days, months, hopefully not years. But the response, the solution will take years, and the problem is occurring over the coming days. That's the mismatch that we're encountering when it comes to energy, when it comes to grain. So will those countries face problems? Yes, they will, like Egypt, like you just mentioned. And people are worried about it because the so-called Arab Spring was triggered in many ways by grain and bread inflation back in 2011. So the risk is there. But the capacity to solve the problem is also there. The question is, will those two curves meet in a reasonable period of time? Sebrina, did I?
Yeah, I have nothing to add to that. I should never speak after Brian.
But what I would say is, just to drill down on what you were saying, people, she approached it very methodically, but maybe you didn't hear the full irony in her voice. The Europeans have announced a lot of terrific solutions that they are in fact implementing, right? That's one of the surprising things.
We just have to make it to 2050 and then we'll be good.
That's right. And in the case of grain, we just have to make it probably to 2024 and then we'll be good. Anybody else want to? Is there one back in the back?
There's one there too.
Gary? Okay, while the mic is coming to you, Gary.
Sean's got it.
Oh, Sean's got it. Okay, good.
I just have a quick question for Mike. Did the Fed wait too long to increase the interest rate?
I think the consensus is they were behind the curve, yes. And we've talked about this often in these economic forums. The Fed, they're human. Fed policy has a history of being haphazard. I do think they're drawing from the experience of the 1930s or the 1970s to move more quickly now, recognizing that they were a little flat-footed as they entered into the second half of 2021. I think that's where you hear all of this talk of 0.5% rate increase, May, June, July. They are now getting on their giddy up, as they say.
But Mike, maybe just to follow up on Pat's question, what does that mean? Because when we listen to the news and they say, oh, in the 70s, the Fed was always behind the curve. Why is it different this time? Meaning, why do we think that they're raising it to 2%, 2.5% is going to do the job instead of 20% like they did in the 1980s?
If we are going from 0.25%, virtually zero, and raising to 2.5% in less than 1 year's time, that has enormous implications all the way through the financial system because it's an exponential rate increase, as opposed to raising interest rates, from 10% to 12%, a so-called 20% increase in the rate. We've already far surpassed a 20% increase just in the last few months, and the guidance for the rest of the year. So I think that's a part of our expectation that this aggressive monetary policy will expeditiously lower the inflation pain. It's just a matter of using the narrative around a year or two as opposed to, a few months.
I just want to add real quickly, it's hard for us to, Carin brought up the point that history doesn't necessarily repeat itself, but it does provide a sort of a grab bag of examples that help us reason and understand by analogy what may be going on now. And because the 1970s are within our living memory, with the exception of Reed and Sebrina, but it's certainly within most of our living memory for many of us in this room, that is the most ready analogy. For very few of us are the years following World War II in our living memory. But if you study and look at the data, you would be surprised at what occurred in 1945, 46, 47, 48. If you go back to World War II, from an economic point of view, what occurred? There was a restriction in supply because the economy was on a war footing. It could not produce the same level of consumer goods that it had previously produced. And we stimulated demand because we went to full employment and we had robust pay and we had 2 million people fighting the war. So that combination of significantly stimulated demand and restricted supply, when the war ended, the people who had the money in their pockets were able to spend immediately, but it took 4 or 5 years for the economy to shift its productive focus back to a civilian footing. If you look at, I wish we had had the chart, I apologize, the inflation rate in 1946 was 20%, and it never fell below 10% in the 5 years after World War II. And then when the 50s came along, and those production bottlenecks had been fully solved, inflation averaged well below 2% a year for 15 years. That, to us, seems like a better analogy for the inflation that we are experiencing today than the 1970s. And that's where I would highlight what Sebrina mentioned. The oil price changes, it's okay, we can talk. The oil price changes that she highlighted, I just want to put an exclamation point on her understated and very rational way of telling that story. Oil prices went up almost 12-fold during those years. 12-fold. Right now they're up 64%. And oil was double its percentage of GDP. Oil consumption in the 70s was twice as high as a percentage of GDP as it is today. That 12-fold increase is, in fact, economically the equivalent of a 25-fold impact that we are not yet experiencing, nor is it likely that we will. That's is that kind of the gist? Yeah, and I would also just add, just very quickly, when you're living through something, it seems incredibly painful, and of course, it seems like it'll never end. But when we think back to the inflation of the 70s, most of us remember that it existed, but we go, oh yeah, that was a thing. That's what we're going through right now.
I also think it's important to remember, and Brian said this, Mike said this, we shut down demand. I mean, that never happened in history. COVID said you have to stay home, and then all of a sudden, we're all together. There are 200 people in the room most of us without a mask. And so we have increased demand with, if you look at the personal savings, we have a lot of money to spend. It's not surprising that we're in an inflationary period right now. It's just not transitory. It's not a couple months, like Brian and Mike said, it's years. We've got to work through this. We've got to get the supply back to reach demand. So just keep that in mind as we're living through this.
Well, it seems like anytime the market goes way down, like it has now, you're going to be in an undervalued situation, which is when you like to buy stocks. So would you say right now, your thinking is, well, we might go down even lower, so we're not sure this is the time to buy, and you're kind of waiting for, well, when's that time going to be? Because otherwise we'd be buying all our stocks at this point.
So I agree. We are, like my slideshow is showing, that we are in an undervalued market. There is potential for the market to continue to go down, but if you're investing for the long term, if you buy now, you're buying at a 15% discount from where you bought at the end of the year, or at the end of 2021. So we think that it's an opportunity to buy, but there may be future opportunity. We don't know that this is the moment to buy, but stocks are not selling for high prices. Companies that we're buying don't have a lot of leverage. We are buying companies with solid business models and that have very solid history of profitability. So the answer is we think that stocks are a good buy. They just might be a little bit better in the future, and we don't know. Well, I mean, it's a good time to buy. It just might be better, or it might be worse.
Well, the other thing is, what I would like to also add to what Carin had to say is, for those of you, many of you were probably, in fact I know, annoyed at some of the heightened capital gains that you experienced last year and in 2020. Okay, we hear your pain. Why did we sell more in 2021 than probably in the last decade, as far back as any of you can remember? Well, we had the 3-lane highway. Well, many of the stocks that we bought 7, 8, 9, 10 years ago that were firmly in the middle lane veered into the fast lane. And the changes in the valuations were dramatic. And so Carin outlined the way we think. We set these quantitative benchmarks, and we try to be as generous as we can. We're willing to pay up for companies that are, we're not trying to steal these companies. We want to buy them at reasonable valuations. We are reasonable people. We want to base it on rational mathematics, rational arithmetic. Carin articulated 1 divided by 15, 6.6%. It's just as simple as that. If something is selling for 50 times earnings, 1 divided by 50 is 2%. If Zoom sells for 400 times earnings, 1 divided by 400 is, what is that?
Not very much.
0.4%.
Small number.
That's the return that you're going to get. So one of the reasons that you saw more sales last year, so this is the reverse, Gary, of your question, was when we own, for example, trucking companies and those clients that have individual stock portfolios. And for the entire history of the trucking industry, they sold at 15, 16 times earnings. The trucking business is a mediocre business at best. And all of a sudden, it's the hottest business you can imagine. And they went to 50 and 60 times earnings over the last 2 years because people adopted the psychology that somehow the trucking business, the growth in profitability that they're experiencing right now will continue well into the future. It will not. So we sold them. It will continue for a year or two, at which point it will look a lot like Zoom. So we incurred taxes when stocks sold substantially above our benchmarks. We always buy. We bought stocks for many of you in January, February, March, now. It's going to continue because we are focused on always buy, when it's appropriate, to always buy things that are reasonably valued, because we have absolutely no clue when these kinds of sell-offs will come. We also have no clue how deep it will go, and we have no clue when it's going to recover. But we do have a few clues on whether or not they are good deals. That was what Carin was talking about. That's what Reed was talking about, and Mike. We have a lot of stocks that are a good deal. Maybe they'll go lower. I have no idea. That's what Carin was saying. But we do know that if you buy stocks at a good deal, where the arithmetic works, we'll look back in the rearview mirror in the middle of our middle lane, and we'll be pretty darn happy with what occurred, as has occurred over the 25 years that we've been in business.
If that's our only technology problem, we did really well.
Yeah.
By the way, we've covered almost all the questions that came in, so if I missed one, please raise your hand, except for cryptocurrency. We'll leave that one for last, and I'll have Reed answer it.
Hi. So my question has to do with your analysis of residential real estate and also your analysis of households. And what I'm wondering is if your analysis included different levels. So have all households been affected the same way? And going forward, are different levels of real estate going to be, what's your outlook on those?
Reed, I'll take the first, and then you take the second. Just quickly, there's a distributional bias to the numbers I was showing. In other words, I may have more cash than my mortgage balance, but my neighbor has less cash and a bigger mortgage. But in aggregate, we're seeing cash exceed total debt for U.S. households. So to be clear, I mean, there are still households out there that might be struggling with that ratio, but the aggregate levels look very strong.
Yeah, I would just say, I mean, it's very difficult to, because it's so unique, there's so many geographical, factors at play in your individual situation. It'd be very difficult to include those kinds of breakdowns in this kind of analysis. So we do that on an individual level when you come to us and have questions on it. That's kind of our approach to it. So what we wanted to show today in the analysis here is really just what is the overarching trend across the U.S. I will say, the obvious difference there is that Colorado stands out compared to the rest of the U.S. In many ways. I mean, I already kind of mentioned the median household here is higher. It's about 30 to 35% higher per square foot than the median across the board. So it has also seen a little bit higher levels of appreciation than what I just showed there. So there's certainly, a different feeling depending on who you are, where you are. Most of our clients, yes, are in Colorado. We have many that are elsewhere. So please let us know if you have the individual questions on that. And we'd like to do that analysis, case by case basis, but that answers your question.
Susan has one.
I got many snap.
Oh, Gary has a mic.
Is there no limit to how much money the U.S. government can borrow? And if there is, what happens when we hit it?
Great question. I'll take part of that. Carin also highlighted that just a second ago. And there is a limit, and you won't be happy when we reach it. Let me just talk a little bit about something that Carin mentioned and maybe emphasize it. We have the highest debt to GDP ratio in this country since World War II. So we're well above 100% total debt to GDP, total debt to the size of the economy. The highest that ratio had ever been was about 120% right at the end of World War II. That World War II, however, was not the highest debt burden. You might be surprised to learn, and I'm stealing just a bit of Carin's thunder because she wrote a whole article about this. In the 80s, We didn't have the lowest debt to GDP ratio, but we were very far from the highest. But we had the highest interest rates ever recorded in US history. So when we had that combination of moderate debt and incredibly high interest rates, interest expense as a percentage of GDP, how much was it?
It exceeded 3%.
3%. Now, the reason that that proved to be, in our opinion, a magic number, because if you think about it, if the economy grows 3% and your federal government interest expense is 3%, what that means is all of your growth is now going to pay interest on government debt. That engendered a political reaction. In our opinion, it's no accident that in the later Reagan years and the Clinton years, deficits fell. It didn't matter that Reagan was considered to be a conservative Republican. It did not matter that Clinton was considered to be a liberal Democrat. When the debt burden exceeded 3% of GDP, all parties cut the deficit and reduced borrowing. Subsequently, when interest rates fell, starting in the 2000s, it did not make one bit of difference that George Bush was a Republican, Obama was a Democrat, and Trump a Republican. And nor does it matter right now that Biden's a Democrat. Borrowing has been going up during this entire period of time, but the burden has fallen. Where was it, Carin?
It's like 1.5% right now.
So we're about half of the debt burden that we had in the 1980s. We are on a trajectory based on the borrowing that we're doing now. If interest rates hit, let's say an average of, because we're just above 100% of GDP in terms of debt, that means when interest rates average a little bit above 3%, we will probably see the same reaction, I would argue. Now, we know when that's going to occur. You may be surprised to learn the answer. That is going to occur 7.4 years from now. Now, why am I being so glib? Because the average maturity of United States Treasury bonds at the present moment is 7.4 years. The average interest rate is 1.5%. That means with higher interest rates today, the government will not immediately face the increased cost of borrowing. If deficits stay roughly where they are now, it will take about 7 years for all of that debt to cycle through to the higher interest rates. So even though the seeds are being planted now for the coming fiscal crisis, they are being planted now, the harvest will not be reaped immediately. It's going to be reaped a few years from now. We will have a fiscal crisis because every crisis creates the next crisis. So when you borrow and hand out 30% of United States GDP, Mike made the point, I hope you guys picked up on that. The stimulus program last year was the third largest economy on the planet Earth. That's what happened. We're getting inflation. It's part and parcel of it. That money had to be borrowed. The Fed printed the money. The Fed is not going to print the money. It's ending. Therefore, inflation will end. It will end over the next couple of years. But we planted the seeds of the US government fiscal crisis. That fiscal crisis will probably look a lot like the fiscal crisis that we already had in the 80s and 90s. It will not look like Russian debt default, Argentinian debt default. That will not occur. We've been through, this movie has played before. We forgot about it. It's coming again. We've lived through it. It won't be the end of the world, but it will engender tremendous screaming and shouting in the political arena. And I am willing to bet that it won't make one bit of difference whether we elect Bernie Sanders or Donald Trump at that moment in time, we will shift towards lower deficits and less borrowing because the king of our country is the bond market. And that king has been napping for quite some time. Okay. Let me just thank you all for attending. I want to make sure that everybody gets out on time. We loved having you in person, and for those of you on Zoom, we'd love to have you in person in the future. We're good.
We're good.
Okay.
We're good. Okay,
Thank you. Thank you for attending, and enjoy the museum.